Hello everyone and welcome back to the channel, your go-to source for understanding the complex world of hard-to-borrow stocks and potential short squeeze dynamics. Today, we're diving deep into a specific company that has landed squarely on our screener, LHSW International Group Limited, ticker symbol LHSW. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. LHSW International Group Limited, or LHSW, operates primarily in the technology and software infrastructure sector in China. Through its subsidiaries, LHSW provides advanced machine vision products and solutions, including industrial machine vision, artificial intelligence products like face recognition and AI behavior analysis, and intelligent recurrent products. This is a microcap company currently sitting at a market cap of approximately $7.02 million. Looking at recent price action, LHSW has seen a plus 1.37% change today, but a slight dip of minus 1.33% over the last 5 days, and a 0.18% change over the last 30 days. Volume today was a mere 33,400 shares, which is significantly lower than its 30-day average volume of 4,047,622 shares, indicating a relative volume of the Xerox average. What is cost to borrow and why it matters? Before we get into why LHSW is on our radar, let's quickly explain what cost to borrow means. When you want to short a stock, you essentially borrow shares from another investor, sell them, and hope to buy them back later at a lower price for a profit. But borrowing those shares isn't free. There's a daily fee and interest rate paid to the lender. This is the cost to borrow, or CTB. If demand to borrow shares is extremely high, and the supply of shares available to lend is low, this fee can skyrocket, sometimes exceeding 100% on an annualized basis. This high cost can significantly eat into a short seller's potential profits and even force them to cover their positions. Why this stock is hard to borrow right now. Now, let's talk about LHSW. This stock has appeared on our hard-to-borrow screener with some truly eye-popping numbers. The annualized cost to borrow fee for LHSW currently stands at an astounding 645.5%. Even more telling, this CTB has seen significant momentum, increasing by plus 58 percentage points over the last 5 trading days alone. Should chart CTB percentage over time. The supply of shares available to borrow is critically low, with only 25,000 shares currently reported as available. When you consider LHSW's estimated float is around 1.0 million shares, having only 25,000 shares left to borrow means that a substantial portion of the float is already tied up in short positions, or simply not available to lend. Our internal composite squeeze score, which factors in CTB, momentum, borrow supply, float size, and technicals, currently rates LHSW at 40.3 out of 100. Squeeze mechanics explained. So, what does it mean when a stock like LHSW is hard to borrow with such a high CTB? It means short sellers are paying a premium to maintain their positions. If the stock price starts to rise, or if the supply of borrowable shares continues to shrink, these short sellers can face immense pressure. They might be forced to buy back shares in the open market to close their positions, especially if the borrowing costs become unsustainable. This forced buying creates significant upward price pressure, which can trigger a cascade of short sellers covering, leading to what we call a short squeeze. It's a feedback loop. Rising prices force more shorts to cover, which drives prices even higher. However, it's crucial to understand that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have very strong conviction that the stock will eventually decline, and they are willing to pay these high fees to stay in their positions. Highlight CDB. Dilution risk check. An important factor in any short squeeze thesis is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This typically reduces the value of existing shares and can offset or completely negate any upward price movement from a short squeeze. For LHSW, our check found no recent dilutive SEC filings such as -1s, -3s, or 424 BS in the last 90 days, which is a positive sign for any potential squeeze scenario. Recent reverse split watch. Another critical piece of information for LHSW is its recent reverse stock split. The company executed a 1:4-16 reverse stock split on June 22, 2026, which was just 29 days ago. A reverse split reduces the total number of outstanding shares and, in theory, resets the share price higher proportionally. While reverse splits are often seen as a desperate measure by struggling companies, historically, many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split. Chart price action after RS. This is a pattern observed in some small cap names, but it is by no means a guarantee, and investors should be acutely aware of the added risks associated with post-split volatility. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For LHSW, keep a close eye on the cost to borrow, which currently sits at that eye-watering 645.5%, and the diminishing supply of only 25,000 shares available to borrow. Look for any significant increases in trading volume, which has been extremely low today as CRX its average. Sustained higher volume accompanying upward price movement could signal increased interest and potential short covering. Conversely, if volume remains low and the price continues to drift, it may indicate short sellers are comfortable with their positions despite the high fees. Remember, the market for microcaps like LHSW can be highly volatile and unpredictable. Soil International Group Limited LHSW presents an interesting case study with its astronomical cost to borrow, dwindling share supply, and the recent reverse split occurring just under a month ago. These are all factors that can contribute to a short squeeze, but it's vital to weigh the risks and understand that these conditions do not guarantee a specific outcome. As always, do your homework, understand the company, and manage your risk. If you found this analysis helpful, please hit that like button, subscribe for more unique stock insights, and let us know in the comments if there are any other hard-to-borrow stocks you'd like us to cover.